midterm case study to prepare for the midterm question. The movie we are putting together is called Kill Me Now, budget 13 million. The film is an action thriller and it has A-level cast attached, and that is why the international sales projections came in at 75% of the film's estimated budget, which is $13 million. These are the low, meaning the take projections we're talking about here. And then we're also assuming that the US distribution rights will be sold after the film is finished and after it's being screened in the festivals. And we're hoping to make 30% of the budget from a US distributor. The budget strike price, which is defined as the full budget minus any in-kind services or deferments, which are costs that have been budgeted but are actually not payable because they're being deferred or being taken out of the budget entirely. So that is the amount we are looking to finance through the various finance sources we are going through in this case study. Let's take a look at some of the assumptions for our film Kill Me Now. The international pre-sales are established at 35% of the budget. So the sales agent went ahead and did some pre-sales to various distributors in the foreign territories and was able to cover pre-sale distribution agreements in the amount totaling 35% of the budget. The sales agent will then receive a 20% down payment from these distributors who pre-bought the movie, and he is holding that down payment for us. This will be the first monies that we will have available to cover a portion of our financing. The sales agent will deduct the sales and distribution fee of 16% from any monies that are coming in, which includes this down payment. The film is managed by a collection agent that will charge us 1% of revenues arriving in the collection account. The bank will provide a pre-sale loan of 90% of the pre-sales, meaning 90% of the pre-sale contracts will be cash flowed by the bank, and the bank will charge a 5% interest fee to do this portion of the loan. For the gap portion of the loan, the bank will look at all the available rights we have not sold yet, meaning all our sales estimates minus all our pre-sales. That will be the collateral for the gap loan. The gap lender will then divide that collateral by 2 because he needs a 200% coverage of the gap loan amount. So the gap loan amount will then be subject to an interest rate of 9% of whatever that loan amount is. Remember, you will never get more than 20% of your budget as a gap loan. A junior lender comes in and provides 10% of the actual production costs, which is the strike price in this case, and will charge us a 15% interest-free upfront, as well as $45,000 in legal fees. The junior lender will also demand a 5% profit participation from revenues. The production incentive lender will cash flow 25% of the production, which is the actual expenses that are being spent, which again is the strike price, and they will charge us 15% of that incentive loan as a fee. They'll also charge us an executive producer fee of $10,000 and a legal fee of $15,000, all of which is being deducted from the loan amount. We are happy to announce that a sponsorship came in for this movie of $500,000. The advertising agency charges us 25% of that as a fee, and the brand pays 50% of the sponsorship in the first installment payment, and 50% once the film is finished. We were also able to secure some crowdsourcing money in the amount of $250,000, which are basically in-kind services that we have budgeted in our line items, and these crew members who are giving us their work for free will then reduce our budget to arrive at the strike price. These crew members receive a profit participation of 2% instead of payment for such services. We also receive crowdfunding for $250,000, which is an investment. We're paying a 25% admin fee for that, and the crowdfunders want 2% profit participation. We receive a music investment for a company that will recoup against music royalty rights and will pay us $120,000, since we budgeted a music budget, and it is again something that is not being paid because we were able to have this portion covered through an investment. We will then reduce this $120,000 from the budget to arrive at the strike price. The equity investor would find the balance that is needed to reach the strike price and charge us a 20% premium plus the industry standard profit participation. The question then is, how much money will we be making as profits as producers? Let's look at our valuation for this film. We had a film that is $13 million in the budget range, and 75% of that is projected to be received from international distribution rights revenues. That is $9,750,000. We know that we're going to secure 35% in pre-sales, which is $4,550,000. We also know that we will be receiving a down payment on that, which is $910,000. That is 20% of our pre-sale amount. And we know that we have to pay the sales agent 16% of that, which will leave us with $764,400 available to be used to cover a portion of our budget. We will assume that we are going to get 30% of the budget, $3,900,000 from a US distributor. So altogether, the worldwide gross distribution revenues that we are going by to establish our finance plan is $13,650,000. Let's start with our senior loan. What would that look like? Remember, we had pre-sales in the amount of 35% of the budget, but the bank will look at these contracts and discount them. So the bank will only give us 90% of the value of the pre-sales, which in this case is $4,095,000. The bank will then recognize the fact that we already received 20% for those pre-sales and will deduct the down payment that we received, which was $910,000. So the gross pre-sale loan amount in this case would be $3,185,000. The bank will then charge an interest of 5% and will deduct the interest up front. And that would be $159,250 because that is 5% of $3,185,000. We are then left with a net pre-sale loan amount of $3,025,750. Now let's look at the gap loan. The unsold rights, which is all our sales estimates minus our pre-sales, are left to show $5,200,000 in available rights that we can still sell. The bank will look at that as a 50% collateral value, which is $2,600,000, and will give us a gross gap loan for $2,600,000. The interest rate for that is 9%, which is $234,000. The bank will also charge a loan fee of $50,000. So we're left with $2,316,000 on the gap loan. Altogether, we are left with $5,341,750, which we can use to finance a portion of our budget. But remember, we have to pay back the gross bank loan that includes all the fees, all the interest fees, and all the loan fees, because we haven't actually given the bank a check to pay for those fees. They're being reserved and they're being paid for when we are making revenues through distribution. That means our gross bank loan that is going to find its way into our recoupment schedule to be repaid is $5,785,000. The junior lender is willing to give us 10% of the actual production cost, which is the strike price. In this case, that would be $1,263,000. They're charging us 15% of an interest up front and a 45% fee. So we are left with $1,028,550 to cover a portion of our budget. The incentive lender looks at our budget minus all the in-kind services and any line items that are not subject to the incentive, which in our case were the crowdsourcing and the music investment. So the strike price is really what we're looking at here to apply the 25% incentive component. The lender will then charge a 15% interest charge, an executive producer fee of $10,000 and a legal fee of $15,000, all of which is being deducted up front, which is why we're left with a production incentive loan of $2,658,875. The brand integration sponsorship of $500,000 is being given to us subject to an agency fee that's being deducted of $125,000. So we're left with $375,000, but the brand will only pay us 50% now at closing, and 50% will be payable when the movie is finished. So we're adding it then to our revenues. We did some crowdfunding of $250,000, and the fee that was due by the crowdfunding managing site is 25% of that, so we're left with $187,500 to be used for our budget. These two line items of our funding schedule are not going to be actual, how do I say this, funding sources, because they are reducing the budget by these amounts. So the crowdsourcing of $250,000 and the music investment of $120,000 cover certain budgeted line items, and they are reducing our budget to arrive at the strike price. When we're looking at all our funding sources that we have established so far, we can see that we have right now $10,186,775 available to cover the production costs, but we need more because we need to cover our strike price budget, and we are missing $2,461,425,000, which are provided to us through our equity investor. And this amount reflects 18.93% in relation to the strike price. And here's our detailed funding schedule. It's quite small. That is why in the module you're finding an Excel sheet that you can download and you can go through, which is obviously much more convenient than squinting your eyes and having to look at this here. But I wanted it to be in this presentation, so we have this presentation complete with everything that we need. Now the movie is being produced, it's been finished, it's being delivered, it's been screened, everyone's happy, people are at the festivals and distributors are buying the rights, and we now have started to have money coming in. Altogether, we get in our US distribution for $3.9 million, and we get our international now coming in at $8,840,000. Remember, we already got $910,000, so we're not going to get that again. Altogether, we are making $12,740,000 from distribution rights revenues. And then, remember, the brand integration. Second installment is now due, $187,500. So altogether, we have revenues coming into the collection account of $12,927,500. So let's take a look at the expenses that are being paid from these gross distribution revenues. We're paying our collection agent 1% of the revenues that just hit the collection account, which comes to $129,275. And then we're now paying the gross bank loan back, which includes all the interest charges and loan charges, which was $5,785,000. We're paying our sales agent now, who gets 16% of the international sales that he has generated. And of course, this amount does not include the pre-sales sales fee that we already paid in connection with the down payment. So we're now paying $2,038,400 here to the sales agent. Then we have to pay the gross junior loan, which is $1,263,000. The junior lender required a premium payment of 5%. So additionally, we're paying the junior lender $63,150. And then we're paying our equity back, which was $2,461,425,000, and the equity lender required a 20% premium, which would then reflect $492,285. That is 20% of $2,461,425,000. So altogether, if we look at all these expenses that are payable to the collection agent, as we're paying back our senior loan, paying the distribution fees to the sales agent and expenses, and also paying our junior loan with premium and paying our equity with premium, we all together have an expenses now of $12,232,535,000. And if we run those expenses again against our distribution revenues, we are left with net revenues of $507,465. In order to figure out our profit participation, we're going to look at our total gross revenues of $12,927,500, and we're deducting all our expenses. We have the collection agent who is going to charge 1% of the monies received in the collection account, and it's $129,275. We're going to recoup our bank loan, including all the interest fees, all the loan and legal fees, and that gross bank loan is $5,785,000. We're then going to pay the sales agent at $16% at $2,038,400.
Remember that any fees we would have paid here to the sales agent on the down payment portion would not be charged here again. And then we are paying our junior loan. The gross amount here is 1,263,000, and we are paying a premium of 5% of that amount, 63,150. And last but not least, we're paying back the equity, 2,461,425, and for that we would charge a premium of 20%, 492,285. So altogether our expenses are 12,232,535. And if we deduct our expenses from our gross revenues, we are left with net profits of 694,965.
This case study is one where you will find a very similar one in your midterm. So it is good to take a close look at this and follow the steps when you're doing a similar case study in preparation for the midterm. And if you have any questions, you know to contact me through Canvas or set up a one-on-one with me, and I'm happy to walk you through the case study.